In a surprising twist for markets and global economic watchers, the U.S. Federal Reserve has moved to slow its rate cut trajectory, signaling a likely pause in future interest rate cuts after 3 consecutive reductions this year. This decision comes amid persistent inflation, delayed economic data, and uncertainty around the Fed's leadership transition. At its December meeting, the Federal Reserve cut the benchmark interest rate by 0.25%, bringing the federal funds target range to 3.50% to 3.75%, marking the 3rd straight cut in 2025. However, in a move that caught many investors off guard, policymakers signaled that further cuts are unlikely in the near term, hinting that this recent reduction could be the last for now. Even though the Fed eased rates yet again, its future guidance hinted that the central bank may pause further cuts unless clearer economic signals emerge. That's a big shift from market expectations, which have been pricing in multiple cuts in 2026. Economists describe this moment as a period of data darkness. That's because a 43-day federal government shutdown earlier in the year delayed key economic reports, making it hard for the Fed to judge the true direction of inflation and the job market. Without fresh, reliable data, policymakers are unwilling to commit to aggressive easing, especially with inflation still running above the Fed's comfort zone and labor market signals mixed. Adding to the uncertainty is the upcoming change in Fed leadership. Chair Jerome Powell's term ends in May 2026, and President Trump has suggested he may replace him, reportedly eyeing economic advisor Kevin Hassett as a leading successor. This anticipated transition injects even more unpredictability into the Fed's future policy direction. Some Fed officials still support reducing rates further, but others want to hold steady, reflecting a deep internal debate on how best to balance the economy's competing pressures. Investors now face one of the trickiest outlooks in years. Small blue diamond uncertain monetary policy. The shift from predictable cuts to a data-dependent, cautionary stance makes it harder to forecast where rates are headed. Small blue diamond economic data gaps. Delays in critical reports make interpreting inflation and job figures more guesswork than science. Small blue diamond market volatility. Stocks and bonds could react sharply to each new data release, especially since investors have been counting on easier policy ahead. Some strategists warn that further rate cuts, only if the economy weakens, could actually spook markets rather than reassure them, because cuts in that scenario might signal recessionary pressures rather than healthy growth. This moment highlights the tightrope the Fed is walking, trying to support growth without reigniting inflation, while also navigating political pressure and unclear economic signals. The era of predictable rate cuts may be over, at least for now. Instead, we're entering a phase where market expectations hinge on unpredictable data releases and a changing leadership dynamic. That's not just a story about interest rates. It's a story about how uncertainty itself has become one of the biggest economic risks in 2026.